Tomorrow morning, millions of bank accounts across America will receive deposits that could reach $2,400. And if you're counting on Social Security, what you don't know about this payment batch could cost you money. The Social Security Administration has just confirmed a new wave of deposits hitting accounts. But here's what most people are missing. Not everyone gets paid on the same day, and understanding your specific payment schedule could mean the difference between financial planning and financial chaos. Right now, the SSA operates on a strict calendar system based on your birth date and when you first started claiming benefits. If you were born between the 1st and 10th of any month, your money arrives on the second Wednesday. Born between the 11th and 20th, that's the third Wednesday. And if your birthday falls between the 21st and 31st, you're looking at the fourth Wednesday of each month. But here's where it gets critical. Supplemental payments, cost of living adjustments, and even one-time deposits can change these amounts dramatically. The real question isn't just when your money arrives, it's whether you're getting everything you're entitled to receive. Let's break down exactly what's coming, who qualifies, and how to verify you're not leaving a single dollar on the table. Let me tell you something that most people don't realize until it's too late. The Social Security Administration processes over 70 million payments every single month, and each one of those payments follows a system that's been carefully designed over decades. But here's the thing that keeps financial advisors up at night. Thousands of seniors are missing out on money they've already earned simply because they don't understand how this system actually works. When we talk about a $2,400 deposit hitting your account tomorrow, we're not just talking about your regular monthly benefit. We're talking about a combination of factors that include your primary insurance amount, any cost of living adjustments that have been applied, potential back payments if there were delays in processing, and supplemental payments that you might qualify for based on your specific circumstances. Now let's get into the real mechanics of how tomorrow's payment batch actually works, because this is where things get interesting. The Social Security Administration doesn't just randomly send out payments whenever they feel like it. They follow what's called a staggered payment schedule, and this schedule has been in place since 1987, when Congress decided that sending all Social Security payments on the third of every month was creating massive logistical problems for banks and financial institutions across the country. So they split it up based on birth dates, and this is crucial information that every beneficiary needs to have written down somewhere safe. If you started receiving benefits before May 1997, you're part of what they call the legacy group, and your payments come on the third day of every month, regardless of your birth date. But if you started receiving benefits after that cutoff date, then your payment day depends entirely on which part of the month you were born in. Here's where people start getting confused. And honestly, I don't blame them, because the Social Security Administration doesn't exactly make this information easy to find. When you look at your birth certificate and see that date, that's what determines your payment Wednesday. The second Wednesday of the month belongs to people born between the 1st and the 10th. The third Wednesday goes to those born between the 11th and the 20th. And the fourth Wednesday is reserved for anyone born between the 21st and the 31st. But tomorrow's batch is special, and I'm going to explain exactly why in just a moment, because there are additional payments being included that don't follow the normal schedule, and if you're not paying attention, you might miss important information about money that's legally yours. The $2,400 figure that we're talking about isn't just pulled out of thin air. The average Social Security retirement benefit in 2025 is sitting at around $1,876 per month for individual retirees. But here's what makes this particular payment batch different. We're looking at a combination of regular monthly benefits plus potential supplementary payments that some seniors qualify for, but many don't even know exist. Let me break this down in a way that actually makes sense for your wallet. If you're receiving the maximum Social Security benefit because you worked for 35 years at or above the maximum taxable earnings limit and you delayed claiming until age 70, your monthly payment could be as high as $4,973. That's the absolute ceiling. But most people aren't getting that amount, and that's perfectly normal because most people didn't earn the maximum taxable income for 3.5 decades straight. What we're seeing with tomorrow's deposit is something more nuanced. The Social Security Administration periodically issues what are called supplemental payments, and these can come from several different sources. First, there's the annual cost of living adjustment, which for 2025 came in at 2.5%. This means that if you were getting $1,800 per month in 2024, your payment automatically increased to approximately $1,845 starting in January 2025. But here's where it gets tricky. Sometimes the SSA makes errors in calculating these adjustments, and when they catch these errors, they issue back payments to make up the difference. These back payments can add several $100s to your regular monthly deposit, and they usually come without much warning except for a notice in the mail that arrives either right before or right after the money hits your account. Another source of additional funds in tomorrow's batch could be related to supplemental security income, commonly known as SSI. Now, SSI is different from regular Social Security retirement benefits, but many seniors receive both programs simultaneously. SSI is needs-based, meaning it's designed to help people who have limited income and resources, and the monthly federal payment for 2025 is around $943 for an individual. If you qualify for both Social Security retirement and SSI, these payments are calculated separately and sometimes arrive in the same deposit, which can make your total monthly income appear much higher than your base Social Security benefit alone. The key thing to understand is that SSI payments actually follow a different schedule than regular Social Security. They typically arrive on the first of the month, but when payment dates fall on weekends or holidays, things get shifted around, and multiple payments can end up hitting your account on the same day. Let me talk about something that hardly anyone discusses but absolutely should: the taxation of Social Security benefits. This is critical information because depending on your total income, you might have to pay federal income tax on up to 85% of your Social Security benefits. Now, before you panic, understand that this doesn't mean the government takes 85% of your check. It means that up to 85% of your benefit amount could be considered taxable income when you file your tax return. Here's how it works. The IRS looks at what they call your combined income, which is your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefits. If you're filing as an individual and your combined income is between $25,000 and $34,000, you may have to pay income tax on up to 50% of your benefits. If your combined income exceeds $34,000, up to 85% of your benefits may be taxable. For married couples filing jointly, these thresholds are $32,000 and $44,000 respectively. Now, let's talk about something that affects thousands of beneficiaries but rarely gets explained properly: the windfall elimination provision and the government pension offset. These are two rules that can significantly reduce your Social Security benefits if you also receive a pension from work where you didn't pay Social Security taxes, which is common for certain government employees, teachers in some states, and people who worked for employers who opted out of Social Security. The windfall elimination provision can reduce your Social Security benefit by up to half of your pension amount, though there's a maximum reduction limit that gets adjusted annually. The government pension offset primarily affects spousal and survivor benefits, and it reduces those benefits by 2/3 of your government pension amount. These provisions are incredibly complex, and many people don't discover they're affected until they actually apply for benefits and see a much smaller payment than they were expecting based on the SSA's online calculators. Here's something else that's absolutely essential to understand about tomorrow's payment: the difference between your primary insurance amount and your actual benefit amount. Your primary insurance amount is the benefit you'd receive if you claimed Social Security at your full retirement age, which is 67, for anyone born in 1960 or later. But your actual benefit amount depends on when you choose to start claiming. You can claim as early as 62, but if you do, your benefit gets reduced by approximately 30% compared to waiting until your full retirement age. On the flip side, if you delay claiming past your full retirement age, you earn delayed retirement credits that increase your benefit by 8%. For each year you wait up until age 70. So, someone born in 1960 with a primary insurance amount of $2,000 would only get about $1,400 if they claimed at 62, but would get $2,480 if they waited until 70. This is exactly why some people receiving tomorrow's payment are seeing amounts that seem surprisingly high. They're collecting those delayed retirement credits that they earned by waiting. Let me share something that financial experts know, but most regular folks don't. Social Security benefits can continue to increase even after you start receiving them, and not just because of cost of living adjustments. If you're working while receiving Social Security benefits before reaching your full retirement age, there's an earnings test that can temporarily reduce your benefits if you earn more than a certain threshold. For 2025, that threshold is $23,400 for people who won't reach full retirement age during the year. If you earn more than that, the SSA withholds $1 in benefits for every $2 you earn above the limit. But here's the good news that nobody tells you. Those withheld benefits aren't gone forever. Once you reach your full retirement age, the Social Security Administration recalculates your benefit to account for the months when benefits were withheld, effectively giving you credit for those payments in the form of a permanently higher monthly benefit going forward. Another factor that can boost your payment is if the Social Security Administration discovers that your earnings record was incomplete or incorrect. This happens more often than you'd think, especially for people who had multiple jobs, worked for small businesses that might have had payroll issues, or had name changes that caused administrative confusion. The SSA is supposed to automatically update your earnings record each year based on what employers report. But mistakes do happen. If you've ever checked your Social Security statement and noticed that your earnings for a particular year seemed wrong, and you contacted the SSA to correct it, you might see an adjustment payment when they recalculate your benefits based on the corrected earnings. These adjustment payments can be substantial, especially if the error affected multiple years or occurred during your highest earning years, which are the ones that matter most for your benefit calculation. Let's talk about survivor benefits for a moment, because this is another area where people can see unexpectedly large payments. If you're a widow or widower receiving survivor benefits based on your deceased spouse's earnings record, you might be entitled to more money than you're currently receiving, especially if your spouse had delayed claiming their own benefits or had high lifetime earnings. Survivor benefits are calculated based on what your spouse was receiving or would have been entitled to receive, and they can be as high as 100% of that amount, depending on your age when you start claiming them. If you claimed survivor benefits early and are now at or past your full retirement age, you might want to check whether switching to your own retirement benefit would give you more money, or vice versa. The rules around this are complicated, but the SSA allows you to switch between different types of benefits if it's to your advantage, and many people don't realize this option exists. Here's something about Medicare premiums that directly affects your Social Security payment and might explain why your net deposit amount changes from year to year. If you're enrolled in Medicare Part B and Part D, those premiums are typically deducted directly from your Social Security payment before it hits your bank account. The standard Part B premium for 2025 is $185 per month for most people. But if your income exceeds certain thresholds, you'll pay an income-related monthly adjustment amount that can push your premium much higher. These thresholds are based on your modified adjusted gross income from 2 years prior, so your 2025 premiums are based on your 2023 tax return. If you had a one-time spike in income 2 years ago, maybe you sold a property or took a large retirement account distribution, you could be paying higher Medicare premiums this year, even if your current income is much lower. The good news is that you can appeal these premium adjustments if you've experienced certain life-changing events like retirement, loss of a spouse, or loss of income-producing property. Now, let's address something that causes confusion every single year: the timing of cost of living adjustments and when they actually show up in your bank account. The COLA is announced in October of each year, typically around the second week of the month, and it takes effect for benefits payable in January of the following year. But here's where timing gets weird. December's Social Security payment is actually January's benefit paid early because of the holiday schedule. So when you see news about a COLA increase taking effect in January, you might actually see that increase in your December payment depending on your payment schedule. This is why some people notice their payment amount changed in what seems like the wrong month. It's not a mistake. It's just the SSA's way of handling the calendar around holidays. Let me tell you about direct deposit versus paper checks because this still matters more than people realize. If you're still receiving Social Security payments by paper check in the mail, you're in an increasingly small minority, and more importantly, you're at risk. The federal government has required direct deposit for all benefit payments since March 2013, with only a few exceptions for people who can demonstrate they truly don't have access to a bank account or who face certain hardships. Paper checks can get lost, stolen, delayed in the mail, or damaged. They also take longer to access since you have to wait for mail delivery and then either deposit the check or cash it somewhere. If you're still getting paper checks and tomorrow's payment is supposed to include yours, you need to understand that it'll take several additional days to actually reach you compared to people who have direct deposit set up. The SSA strongly encourages everyone to sign up for direct deposit, and if you don't have a traditional bank account, you can use the Direct Express debit card program, which is specifically designed for federal benefit recipients. Here's something about appealing Social Security decisions that every beneficiary should know, but most don't. If you believe your benefit amount is wrong, or if the SSA made a decision about your benefits that you disagree with, you have the right to appeal. You have 60 days from the date you receive a decision to file an appeal, and there are 4 levels to the appeals process. The first level is called reconsideration, where someone who wasn't involved in the original decision reviews your case. If you disagree with that decision, you can request a hearing before an administrative law judge. Beyond that, there's review by the Appeals Council and potentially federal court review. The important thing is that you don't just have to accept what the SSA tells you if you genuinely believe there's been an error. Many people have successfully appealed benefit calculations and received years' worth of back payments as a result. The key is documenting everything, keeping copies of all correspondence, and not missing those appeal deadlines because once they pass, it becomes much harder to challenge a decision. Let's talk about representative payees, because this affects many seniors who need help managing their benefits. If the Social Security Administration determines that a beneficiary isn't capable of managing their own payments due to physical or mental limitations, they'll appoint a representative payee to receive and manage those benefits on the beneficiary's behalf. This is often a family member, but it can also be a professional organization. Representative payees have legal obligations to use the benefits for the beneficiary's current needs, save any excess for future needs, and report how the money is spent to the SSA. If you're acting as a representative payee for a parent or other family member, you need to keep careful records because the SSA does periodic reviews and can ask for detailed accounting of how benefits were spent. On the flip side, if you suspect that someone acting as your representative payee or a family member's representative payee is misusing benefits, you can and should report it to the SSA immediately because that's a serious form of fraud. Tomorrow's payment batch represents more than just money hitting bank accounts across America. It represents the fulfillment of a social contract that's been in place since 1935. When President Franklin Roosevelt signed the Social Security Act into law, you paid into this system throughout your working years, with every paycheck contributing through FICA taxes, and now you're receiving the benefits you earned. Understanding exactly how much you should be getting, why that amount might vary from month to month, and what factors can increase or decrease your payment isn't just about being informed. It's about ensuring you receive every single dollar you're entitled to after decades of hard work and contribution to this system.